the global automotive industry is facing an unprecedented upheaval, one that is sending shockwaves through boardrooms, assembly lines, and showrooms across continents. What was once considered a stable and interconnected market is now being tested like never before. In a move unimaginable a decade ago, industry giants Toyota and Honda have announced a complete halt to exports of Japanese-made vehicles to the United States. This decision marks a dramatic departure from decades of close economic ties and mutual growth. This is not a temporary pause, it's a permanent break, triggered by sweeping tariffs imposed by the Trump administration. The new trade barriers have made it economically unfeasible for Japanese automakers to continue their exports. The era of Japanese cars flooding American ports is over, signaling a dramatic shift in global trade. The familiar sight of rows of Japanese vehicles arriving at U.S. docks will soon be a thing of the past. This decision threatens to unravel supply chains that have powered prosperity on both sides of the Pacific for generations. Thousands of jobs from factory workers to logistics experts now hang in the balance as companies scramble to adapt. The impact will ripple from car prices at dealerships, likely driving them higher, to the stability of the US-Japan alliance, which has long been anchored by robust economic cooperation. Diplomatic relations are now under new strain. For decades, made in Japan meant reliability, innovation, and partnership. Now, that chapter has abruptly closed, leaving consumers and industry insiders alike to wonder what comes next. The move forces a reckoning with the true costs of protectionism, as intended job protections give way to unforeseen consequences, factory closures, layoffs, and economic uncertainty in both nations. The world is watching as multinational giants and governments alike scramble to rewrite the rules of global commerce in real time, seeking new strategies and alliances. The end of Japanese car exports to the US marks a turning point in the story of globalization, raising urgent questions about the future of international trade and economic cooperation. The US-Japan auto relationship has always been a mix of rivalry and innovation. In the 1960s and 70s, Japanese brands like Toyota and Honda gained ground in America with fuel-efficient cars, especially after the 1973 oil crisis. Their success sparked backlash. By the 1980s, car wars erupted, with accusations of unfair trade and public protests. The 1981 Voluntary Export Restraint Agreement limited Japanese car exports, but it pushed automakers to build factories in the U.S. plants in Kentucky and Ohio, created thousands of American jobs, blurring the lines between foreign and domestic. Over decades, Japanese brands became deeply woven into the U.S. economy, balancing imports with local production. This hybrid model stabilized trade tensions and benefited both countries. But that delicate balance has now been upended. The status quo is gone. The Trump administration's tariffs shattered the fragile peace in auto trade. Citing national security, the U.S. imposed steep tariffs on imported cars and parts, aiming to boost domestic manufacturing. For Toyota and Honda, a 25% tariff meant thousands more per car, an unsustainable hit. Japan exported 1.7 million vehicles to the U.S. annually, worth over $40 billion, including popular models like the Ray V4 and Civic Type R. The tariffs threatened this entire flow, creating uncertainty and slashing profitability. Japanese automakers argued they already invested billions in U.S. plants and jobs. The tariffs, they said, unfairly punished global production strategies. After failed negotiations and mounting losses, Toyota and Honda made the drastic choice to cut off exports. A once unthinkable move became inevitable. The global auto map was redrawn overnight. The announcement was swift and coordinated, catching many by surprise and signaling a major turning point for the global auto industry. In Tokyo, Toyota and Honda executives stood side by side, declaring an immediate end to all Japan-built car shipments to the US, a move that sent shockwaves through both countries' automotive sectors. Toyota's CEO described the new tariffs as an insurmountable wall, explaining that the company was now forced to rethink its entire global strategy and supply chain. Honda's CEO echoed the sentiment, stating, "We cannot subject our loyal customers to soaring prices, nor can we absorb such massive losses. This is a line we simply cannot cross." From this moment forward, only vehicles manufactured in North America will be available for sale in the U.S. market, marking a dramatic shift in how these companies operate. The news sent global stock markets into turmoil, with auto stocks plummeting and investors scrambling to reassess the future of the industry. Popular models that were previously built exclusively in Japan may soon vanish from US showrooms, leaving both dealers and customers in limbo. Meanwhile, other models will face expensive, years-long transitions as production is shifted and retooled for North American plants, a process fraught with logistical challenges. Dealerships across the country scrambled to assess their current inventory and future lineups, bracing for a period of deep uncertainty and potential shortages. Both Toyota and Honda emphasized that this was not a withdrawal from the US market, but rather a strategic pivot, doubling down on American manufacturing out of necessity, not by choice. Billions of dollars will now be invested to retool and expand plants in Kentucky, Indiana, Alabama, and Ohio, creating new jobs but also significant upheaval. This is a defensive maneuver in an escalating trade war, not a victory lap for anyone involved, and the stakes could not be higher. The US-Japan auto relationship, carefully built over generations, has now been fundamentally altered, with trust and cooperation hanging in the balance. The once steady flow of goods that defined an era has been abruptly disrupted, leaving both sides to navigate a new landscape. The industry now faces a new, uncertain reality, one where adaptation and resilience will be tested like never before. The economic fallout is immediate and far-reaching. American consumers will see higher prices and fewer choices as imports vanish and competition shrinks. Scarcity of popular models will drive up both new and used car prices. Port cities like Long Beach and Baltimore, once hubs for Japanese car imports, face job losses and economic disruption. The logistics and supply chain industries will feel the domino effect with layoffs and lost business. Retooling US factories is slow and costly. Jobs lost at ports won't be quickly replaced in manufacturing. The North American parts supply chain will be strained, risking bottlenecks and further price hikes. Japan's economy will take a hit, and other car-exporting nations may soon face the same dilemma. The global auto machine has been thrown into chaos with no clear end in sight. The political stakes are just as high as the economic ones. The US-Japan alliance, a pillar of stability in Asia, is now under strain. What began as a trade dispute has become a diplomatic challenge, forcing Japan's government onto the defensive. Retaliatory tariffs on US goods, especially agriculture, are now on the table. This tit-for-tat risks escalating into a full-blown trade war, with no real winners. US allies worldwide are rethinking their reliance on American markets, considering new partnerships to hedge against future shocks. The move could weaken America's global alliances and embolden rivals like China. Economic disputes can spill into security cooperation, undermining trust in the Indo-Pacific. The Toyota-Honda decision is more than a business story, it's a geopolitical turning point. The future of US-Japan relations and the broader global order hangs in the balance. The world is watching. To grasp the real impact, listen to those on the ground. In Georgetown, Kentucky, Toyota workers are anxious. New investment means hope, but also uncertainty, retraining, and downtime. "We depend on this plant," says one employee. "We just hope the promises hold." At a Honda dealership in Chicago, owner Sarah Jenkins faces shrinking inventory and frustrated customers. "Some of our best sellers are gone. We're caught in the middle of a policy we can't control." Even Detroit auto workers, once champions of protectionism, are conflicted. "It doesn't feel like a win," says a retiree. "Jobs shift, but prices rise and ports lose out. It's complicated." For every job gained in a factory, another may be lost at a port. Small business owners and workers alike are left scrambling to adapt. The disruption is widespread, and the future feels uncertain for everyone. There are no clear winners, just a new landscape of risk and anxiety. The human cost of policy decisions is now impossible to ignore. Experts warn this is a watershed moment for manufacturing, one that could fundamentally reshape the industry as we know it. Dr. Emily Carter, a leading trade economist, calls it a classic case of tariffs backfiring, injecting chaos and inefficiency into global supply chains that have taken decades to build. "You can't just move production overnight," she says, emphasizing the complexity and scale of these operations. "Expect bottlenecks, higher costs, and a less competitive US market for years to come. The ripple effects will be felt across the entire sector." Industry consultant David Chen notes, "Toyota and Honda are deglobalizing, trading efficiency for tariff-free access. It's a massive gamble that could redefine their business models." Billions will be invested in North American plants, but the big question is whether local suppliers can keep up with the sudden surge in demand. Shortages of key components are likely as everyone scrambles to source locally, leading to delays and uncertainty for manufacturers and consumers alike. The shift could accelerate automation and smart factories, demanding new skills from workers and pushing companies to invest in advanced technologies. This could be the inflection point for Industry 4.0 in U.S. autos, says Chen, referring to the integration of digital technologies and data-driven manufacturing. New jobs may emerge, but they'll require technical training, adaptability, and a willingness to learn new skills as the industry evolves. Dr. Carter warns, even if tariffs are reversed, the old system won't simply return. The changes set in motion may be permanent. The costlier, less efficient model will be locked in, making it difficult for companies to regain their former agility and cost advantages. Consumers will ultimately pay the price, facing higher costs, fewer choices, and lasting disruption in the marketplace. The industry's future is being rewritten in real time, and the stakes for automakers, workers, and consumers couldn't be higher. The consequences of today's decisions will echo for years, shaping the next era of manufacturing in ways we're only beginning to understand. We stand at a crossroads for globalization. Toyota and Honda's decision is more than a headline. It's a symbol of a world in flux. The post-war trade order, built on open markets and integrated supply chains, is under threat from economic nationalism. Multinational corporations are now redrawing the map of commerce based on political risk, not just efficiency. This could spark a trend of reshoring and regionalization, making supply chains more resilient but also more expensive. The world may become less connected with higher prices and fewer choices for consumers. Trade policy's real-world impact is now undeniable, affecting jobs, prices, and global relationships. The future of trade is uncertain. What kind of world do we want to build next?